Hello, I'm Haider Malik, host of the MEMI Financial Group podcast. Today's topic is agriculture supply contracts factoring for Toronto agribusinesses. When you lock in large feed, seed, or fertilizer contracts with food processors or livestock integrators, payment terms can stretch 60 to 120 days, yet you still need cash now for inputs, payroll, and logistics. Invoice factoring can turn those contract receivables into immediate working capital. Here's how Toronto agribusinesses can set it up. 1. What is contract factoring? Mechanics. You sell approved supply contract invoices, feed deliveries, seed shipments, crop inputs to a factoring partner. They advance 80-90% of each invoice's face value, typically within 24-48 hours. When your customer pays, they remit the balance minus a small fee, 1-3%. Recourse versus non-recourse. Recourse. You retain the credit risk if a customer defaults, fees are lower. Non-recourse. The factor assumes default risk. Fees are slightly higher, but you gain protection against bad debts. 2. Key benefits for Toronto agribusinesses. Immediate liquidity. Fund seed orders, fertilizer prepays, and seasonal labor without tapping term loans or lines of credit. Smoother cash flow. Replace lump sum payment waits, often 60 to 120 days, with predictable advances that match your operating cadence. Outsourced collections. Factors handle dunning, dispute resolution, and remittance tracking, freeing your team for production and sales. Credit insights. Many factors provide ongoing credit assessments of integrators and processors, helping you avoid overextension. 3. The factoring process. 1. Partner selection. Choose a factor experienced in agribusiness, someone who understands Ontario livestock contracts, feed mill billing, and commodity season cycles. 2. Approval and onboarding. Submit your customer list and sample contracts. The factor evaluates pay your credit and sets advance and fee rates. 3. Invoice submission. After each delivery, you forward the signed contract invoice electronically. 4. Advance funding. Receive 80 to 90% of face value, often within 2 business days. 5. Collections and settlement. The factor collects payment. Once received, they remit the remaining balance less fees. 4. Choosing the right factoring partner. Industry expertise. Ensure they grasp feed and grain delivery terms, storage in transit clauses, and livestock contract nuances. Advance rates and fees. Compare advance percentages, higher is more cash, and tiered fee schedules that decline as volume increases. Service levels. Evaluate dispute resolution processes, reporting tools, and responsiveness. Contract flexibility. Look for month-to-month terms or easy exits. Avoid multi-year lock-ins if your contract mix shifts seasonally. 5. Best practices for maximum ROI. Accurate contracting. Issue complete, signed invoices promptly. Include delivery receipts, quality certifications, and price adjustment clauses. 2. Customer notification. Inform integrators and processors of the factor's remittance address to prevent misrouted payments. 3. Blend financing. Use factoring for rapid cash needs and retain a small receivables line for routine billing to optimize costs. 4. Monitor KPIs. Track factoring fees as a percentage of revenue and measure days sales outstanding before and after factoring to ensure value. 6. 3 action steps. 1. Audit your contracts. List your top 5 feed or input customers by volume and payment terms. Gather sample invoices and delivery confirmations. 2. Solicit term sheets. Approach 2 to 3 agribusiness focused factoring firms. Compare advance rates, fee schedules, recourse options, and onboarding timelines. 3. Model your cash flow. Simulate your next 90 days of input purchases, payroll, and overheads against potential factoring advances to confirm coverage of all obligations and maintenance of a liquidity buffer. Invoice factoring transforms long-tail supply contracts into an agile financing tool, powering your Toronto agribusinesses growth, smoothing cash flow, and freeing you to focus on farming success rather than collections. If payment delays threaten your operations or expansion, factoring could be the solution you need. I'm Haider Malik. Thanks for listening.